Hi, this is part four of a six-part series of videos on great. Now you have $100,000 to invest. What are your options? In the previous videos, we talked about how to use financial analysis to establish a portfolio and invest your $100,000 you just received. Then we talked about Sector Surfer as a website that provides models and that you can follow, and they assist you managing money and above all managing your risk. In this section here, in this video, we'll talk about how to use moving averages to set up a portfolio and control profitability and risk. In the following two videos, we'll talk about dual momentum strategy and a macro strategy. The models discussed in the following slides are discussed in great details in my two books, Easy Ways to Beat the Market with ETFs and Investing Wisely, It is Easier Than You Think. These models are also reviewed in every issue of the Peter Deck portfolio, and their performance, of course, is computed and shown to our subscribers. These are the buy and sell rules that are used using moving averages. First of all, the buy and sell decision is made at month end. We tested making decisions during the month. They will provide lower returns. So if you want to avoid whipsaws and continuous losses, the best choice is to make decisions at month end. You buy or hold a certain investment if the price is greater than or equal to the 200-day moving average at month end. You sell your investment if the price is lower than the 200-day moving average at month end. These are the portfolios that we follow in every issue of the Peter Deck portfolio. Of course, you can set up your own portfolio and do the same thing. By the way, the program that was used and is being used to compute the performance is portfoliovisualizer.com. It's an excellent way to compute the performance of your portfolio and test your ideas. Anyway, for our purpose I set up two portfolio. One, ETF number one, is sort of conservative. As you can see, there is utilities, staples, healthcare, banks, insurance, and there is aggressive encyclical ETF XLE, which is energy and bonds. So it's a very conservative portfolio. This one, the ETF number two, is more aggressive. There is still insurance. There is financials, which is a cyclical. There is, of course, SPY. This is a defense, technology, and healthcare. So it's a little more aggressive portfolio. The Fidelity and Mutual Fund and Vanguard Mutual Fund and the Vanguard ETF more or less reflect the same ideas, to have portfolios balanced between aggressive and defensive. What I would like you to focus on is these two portfolio. They have 50% in SPY and 50% in XLU. Here they have the portfolio is XLU, bonds, and SPY. The way you interpret these two portfolio is what happens to your portfolio represented in general by SPY when you overweighted with XLU. And this is the same thing. What happens to a generic portfolio, which is mirrored by the SPY performance, when you overweight with utilities and bonds? And the idea is to see how the performance of these two portfolios is going to be when you make it the typical portfolio a little more conservative. This is a table that we show in every issue of the Peter Deck portfolio. These are the portfolio I mentioned before. This is a long-term technical model. What this is represents the S&P 500. What happens when I follow the rules of the 200-day moving average that I mentioned before. This is the S&P 500 buy and hold. So as you can see, a buy and hold rose since 2008. By the way, it's 2008 because not all the ETFs and mutual funds were available before that, so that's why it's 2008. But as you can see, it has a return of annualized return of 8.5%, but has a loss of 48%. It has a volatility 15, which is fairly average, but is high relative to other portfolio. The worst year was lost 37, almost 37%. Currently, from January 2018 to July 31, 2019, the buy and hold has produced 8.5%. Now, what is the purpose of the previous of this portfolios? How would you analyze this thing? Well, the bottom line is, okay, here I lost 48%, here I lost 36%. This is I have volatility. Do I have a portfolio that has roughly the same return but with much less loss here and lower volatility? Well, if you go up the scale, for instance, this one has it because it has almost the same performance. But look here, in the maximum drawdown was 8% instead of 48%. The worst year was minus 80%, 8.2% instead of 37%. So this is you perform like a buy and hold, but with considerably less volatility. Or otherwise, you can go up here, you outperform over the long term 10.2% instead of 8.5%. But look at the loss. You only lose 10%, the worst loss during the period, rather than 48%, or you lose only 4% rather than 36%. With much less volatility, 9.6% instead of 15%. So portfolio number 2 has since 2008 not only has outperformed the buy and hold, but also with much considerably lower drawdowns and lower volatility. So this is how you should analyze, and this is I guess the idea of models. The models allow you to understand what would have to give up if you want a conservative. For instance, let's say you want a conservative portfolio like ETF number 1. Okay, you want only 7% maximum drawdown, very low volatility, almost no losses in the worst year. But again, you want a very conservative portfolio. What happens is that the annualized return is lower than 8.5. So the way you have to analyze this table, and this is the idea of models, is that they help you to understand what do you want. You want more risk, less risk. But if you want more risk, you have better returns, but then you have more drawdowns. But if you want less drawdowns, then you have to accept lower returns. So it helps you understand what you're looking for. Now, another thing that is very important is this column here. Any rule based on moving averages or models, if the market is flat, they're not going to produce returns. You should not expect big returns because you're going to be frustrated if you do. It's just because of the nature of the rules. So for instance, since 2018, the market has produced 8.5%, and instead here, as you can see, the returns have been considerably lower. Of course, what you have to keep in mind, though, that all these models offer the safety of much lower drawdowns in case of a market decline. So this is hopefully helps you understand how you use these models and how it's going to help you guide your setting up your portfolio. What I've shown in the previous slide is backtesting simple model portfolios. And what that helps you is shows you what the performance, and of course the performance changes depending on the ETFs that you choose. The interesting concept, I think, is that you should look at SPY as a generic portfolio of diversified portfolio. So what you could do is to see what happens to that portfolio when you overweight over the long term in things like utilities or bonds. And of course, you see from that previous table, reduces the volatility, reduces the risk, and maybe offers a return over the long term that is just about the same. This kind of work can be done using the website portfoliovisualizer.com that offers this possibility of entering all the ETF or whatever portfolio you wish to test. What is the major advantage of models using moving averages? The major overwhelming advantage of our timing models is to considerably reduce the volatility of the portfolio or the portfolios as measured by the standard deviation and the size of losses, the column under the max drawdowns and worst year, when is compared to the buy and hold strategy for the S&P 500. They offer an unbiased and quite successful risk management tool. And above all, it helps you to manage your emotions, because that's the worst thing that you can do when you manage your portfolio, is to pay attention to your emotions. This is an emotionless way of managing your portfolio. The major disadvantage of model portfolio using moving averages is that they rarely make money in a flat market and will frustrate you with whipsaws even if they will be small. So if the market is flat and there is a lot of volatility, you have to be patient, because the time will come when they will provide you some very attractive returns. This information is analyzed in detail in each issue of the Peter Duck Portfolios, and of course is discussed in great detail in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you very much for listening, and I'll see you really soon.